The Iran war has not just depleted US military stockpile, it has also impacted its economy negatively. In April, US inflation spiked well above Fed's safe zone, and the biggest reason was gas prices, energy prices basically. So how bad is it for a common American? Our next report tells you more.
The world's biggest economy just got hit by a fresh inflation shock. And this time, the trigger is not interest rates, supply chains, or tariffs. It is war in the Middle East. The latest US inflation data shows consumer prices in America surged 3.8% in April 2026 compared to a year ago. That is a sharp jump from the previous month and much higher than what markets were expecting. The biggest reason? Energy prices exploding after the Iran conflict disrupted global oil markets. Petrol prices in the United States have jumped nearly 28% compared to last year. Average gasoline prices have now crossed $4.50 per gallon in several parts of the country. Diesel, aviation fuel, and shipping costs have also moved sharply higher. Why is this happening? The Iran war has increased fears around oil supply disruptions in the Middle East, especially around the Strait of Hormuz, one of the world's most important oil shipping routes. Since the conflict intensified, global crude oil prices have surged. Higher crude prices directly impact transportation, manufacturing, electricity generation, and logistics costs across the world. For the US economy, which had finally started cooling inflation after years of aggressive rate hikes, this is a major setback. The latest data shows energy inflation was the biggest contributor to the overall rise in prices. Food prices also increased because higher fuel costs make farming, packaging, and transportation more expensive. Airline tickets, freight costs, and household utility bills have all started climbing. This now puts the US Federal Reserve in a difficult position. For months, investors were hoping the Fed would begin cutting interest rates in 2026 to support economic growth. But rising inflation could force the central bank to delay rate cuts for longer. And that creates another problem. Higher interest rates increase borrowing costs for businesses and consumers. Home loans, car loans, and credit card debt become more expensive. So the US economy is now facing the risk of slower growth combined with rising prices, something economists often call stagflation fears. If the conflict continues and crude prices remain elevated, inflation pressures could spread across the global economy once again.